Hi everybody, this is Thomas and I'm here with the 2015 second quarter market summary. And the summary gives us insight into which investments were up or down during the quarter and helps us understand our portfolio returns. I'm going to go through the slides pretty quickly, so if you want to pause and look at the material for a longer time, just pause the video and take a look. So this second slide shows us how 6 different categories of global market assets performed. And the theme this quarter is that equities, or stocks, were pretty flat, with US and international emerging markets all just fractional changes. Real estate was the one asset that went down a lot. It's been up a lot in the past few quarters, so it's natural for this to correct. And the big picture and what shaped our performance and most investor performance was a very quick rise in interest rates and a sell-off in bonds prices, and that hit some of our portfolios pretty hard. Our performance ranged from about flat for stock portfolios to down about 3% for our bond portfolios. And the long bond was down 9%. We own some long bonds in many of our portfolios, so that drove performance for the quarter. This is the news during the period. The market, as measured by the S&P 500 or the All Country World Index, was relatively flat. Started and ended around the same price, and these were the news headlines during that period. In world asset classes, this is actually relatively calm, with the top performing asset up 4.5% and the bottom one down 10%. Again, that's the real estate. So that's world asset classes. Then we look at just stocks in the US, pretty smooth again, with a lot of low returns in the middle, and even the worst performing and the best performing not that big of a deal. And this shows you long-term returns for each of these asset classes. International, similarly, relatively calm. The interesting thing about international is that Greece was in the news, recently, and year to date, over the last 6 months, there's positive returns in international developed, but over the 12-month period, they're still negative after having a pretty rough time in the last couple of years. Then emerging markets, similar to developed foreign markets, positive returns year to date, but still negative returns for most of the categories over the 12-month period. Then the countries. This is always interesting to see the diversity of returns in countries. In the developed world over on the left and emerging markets on the right, it's actually pretty smooth relative to what we've seen in previous quarters. And commodities, also, there's big changes from wheat at the top to aluminum at the bottom, and I'm highlighting oil. We've got a very small investment for some clients in oil. We're again thinking about increasing that for a larger number of clients, but we'll have to run it by everybody and see who's up for investing in a little bit of oil, and especially is up in the quarter, but actually since the end of last quarter, and currently it's fallen back down again, and I'm sure you've heard about that in the news. This is always interesting that commodities were so hot for so long, and by turning so hugely negative, this category now has negative returns even all the way out to the 10-year period, and the 1-year period is really pretty poor. So don't concentrate all your assets in a single asset class. Fixed income, we're just looking at the long bond, which this is an aggregate, so that was year to date down 4%. In the quarter it was down 9%, so that hurt our conservative accounts. And then this is the editorial comment, basically DFA's opinion that advisors serve a great role for investors. DFA, of course, doesn't allow investors to invest directly in their funds and insists that they have an advisor that they vet to some degree. Of course, we're approved for DFA funds. So I wanted to just real quickly go to these 2 slides, which is a little bit about this is showing performance for DFA over a long period of time and the S&P index versus a dimensional balance strategy. And dimensional over a long period of time has outperformed. And past performance doesn't predict future performance, but it's the way that they make their returns that has attracted us to them. They track very closely to the indexes, almost like a Vanguard does, which follows the index very closely, but they do things to allow them to outperform. And compared to Vanguard, their returns over long periods of time beats even Vanguard's. Now, this next slide shows that 40% of the time DFA trails its benchmarks, and then 60% of the time it beats its benchmark. And the size of the outperformance and the percentage of time it outperforms leads to outperformance over time. But you have to endure periods. These are entire years. You have to be willing to endure periods of underperformance. And each company and advisory firm and mutual fund company all have different styles. And the key is to adopt a sound style and stick with it and understand that each style is going to have its days in the sun and days when it's got challenges. So we had a little bit of a miss on our versus our benchmarks this quarter, but we think we've got a sound style and a sound process, and we hope you understand how that works. So I hope you find all this material helpful, and if you have any questions, give us a call anytime. Thanks a lot. Bye-bye.